Digital asset regulatory framework that was released last week, that Hines is the executive director of making sure is rolled out, is a collection of recommendations from all the different agencies of the U.S. government that have a role in terms of what they could do to promote the use of digital assets in their particular domain. Of course, I'm interested in the one on taxation, so I went and read through that. And I guess I shouldn't have been surprised, but the digital asset taxation bill that Senator Lummis put forward, all her recommendations are actually in this framework. So I think she had a heads up knowledge of what would be in there. And there are some additional things which I think are significant to crypto traders. Let me kind of summarize that for you. The things that were in the bill with Cynthia Lummis are the wash sale rule, clarification of crypto lending, mark to market pricing for active traders and dealers, and for foreigners investing in the US, they wouldn't be treated as a trade or business, which would oblige them to file a tax return. There is a de minimis reporting rule and the taxation of staking and mining. These all are in the Cynthia Lummis digital asset taxation law. And I have other videos which talk about this. And in general, I'm supportive of all of those, except I think the wash sale rule is just stupid. And I read what Cynthia Lummis said about why the wash sale needs to be applied to digital assets. She said the exact same thing this new digital asset regulatory framework says. And the logic goes, securities, stocks, if you will, are subject to the wash sale rule. Therefore, crypto assets should be subject to the wash sale rule. Now, the wash sale rule is a tax on being stupid. Basically, if you sell an asset for a loss and then buy it back, this is called tax loss harvesting. If you buy it back within 30 days before or after, then you are deprived claiming that loss. Well, why should that happen? What is the compelling financial need for this to happen? How does this stimulate the US economy? How does having this tax penalty, which is what it is, the penalty, why should this be even applied to securities? I think it's high time that the legislators took this law off the books. It's just a tax on stupid. And I'll tell you how you avoid it. And because it's already being done by the securities industry. The reporting of the wash sale rule is done on your brokerage's 1099-B form. And so if you want to do basically a wash sale, what you do is you sell it on one brokerage and then you buy it back on a second brokerage. Neither brokerage knows that a wash sale occurred, so it's never reported to the IRS on the 1099-Bs. It's just so easy to bypass. And it's even easier with digital assets because you can move between crypto exchanges far easier than it is to move stocks between crypto exchanges. It's just a silly rule. It's pointless. It serves no good economic stimulus. And it doesn't prevent it really from happening. It's just a tax on being stupid. So I think the wash sale rule argument is flawed because it's a fundamentally flawed law to begin with. And it should not be applied to securities either. The de minimis reporting sounds good, but in actuality, it still places a total reporting burden on the taxpayer to even record what the small transactions are. So I don't really think that solves any complexity problems for the taxpayer. What was interesting about the digital asset regulatory framework that was proposed by the president's work group is that there is an intent to expand FATCA reporting to digital assets. FATCA stands for the Foreign Administration Tax Compliant Act. And this is a bill that came into place 2010 under Obama, which obliged every bank in the world to report to the US government on the total balances of any US taxpayer in any accounts that they had worldwide. You have to report this twice a year. It was this law that eventually broke the Swiss bank secrecy. Even the Swiss caved and are now reporting all bank accounts of US taxpayers to the US government. Now, they want to expand this to cover digital assets. The challenge, though, is the regulatory structure under which the FATCA law was set up had a penalty, which is if you were a bank and you didn't comply, then the US government could seize any US dollar transfer coming through to your bank at any time because they all had to go through the US correspondent bank system. The problem here is digital assets don't go through the corresponding bank system. It is actually dismantled. Well, I shouldn't say dismantled. It's not in place. There's no similar leverage that the U.S. government has. So I really think it's going to be very difficult to implement. And if I might add, just parenthetically, the move to stable coins away from bank to bank transfers further weakens FATCA to begin with, which is never a law that was terribly popular. And the US government never effectively implemented the leveraging of that data in any sort of tax collection purpose. So, remains to be seen if that's a great thing. I think they'll be hard pressed to expand it. They also are talking about consolidating the foreign account reporting obligations for Form 8938 and FBAR, looking at maybe consolidating those. Right now, there are two anti-money laundering forms that a taxpayer with foreign accounts has to report on a yearly basis when his tax return is due, and they overlap substantially. And there's far better penalty structures under the Form 8938 than the FBAR. So I think they want to consolidate that. That's worth doing. I think that's a good idea. They also want to implement CARF reporting. What's CARF? CARF is an international regulatory standard, stands for Crypto Asset Reporting Framework, and it obliges exchanges to know who is the actual controlling owner or beneficial owner of every account, and to exchange this information with other countries when they request it. So this is an interesting framework. This is basically an international information sharing agreement. The U.S. is not a participant in that agreement at this time. I don't think the U.S. ever will, but the report suggested that the U.S. become a part of that. And they said basically that other people aren't sharing with the U.S. because we don't share with them. It's like, guess that's right. That's why the U.S. is the #1 tax haven in the world for people that aren't U.S. citizens. So this is one of those reasons. They just don't share information. So I doubt that's going to happen. They also are interested in obliging exchanges to share basis information on transfers between other exchanges. So, if you buy something on Coinbase and you transfer it to Kraken, that Coinbase at the time of the transfer will also transfer information about the cost basis of those coins at the time of the transfer. Of course, this would not happen on private wallets. So if you went to your private ledger, then you went back up to Kraken, that information would not be shared. So, there's some basic holes in this whole structure, but these are the things they'd like to do. What do you think about the taxation changes they're proposing? I think, it's all good. It's what people want. So I think it's worth giving to them. But I am against the wash sale rule. And I think a lot of the foreign account reporting is going to be difficult for the IRS to effectively implement. So please like, subscribe, give us your comments at the bottom. It really helps us to get this message out. Thanks very much.